Today, we're going to validate ICT concepts using Orderflow. We'll break down three core ideas: fair value gaps, liquidity sweeps, and order blocks. First, I'll clearly explain what they are from a structural perspective. Then, we'll see how to confirm them using participation data so you can improve precision inside your zones. Because structure tells you where price might react, but order flow tells you if the market is actually committing at that level. And by the end of this video, you'll understand why some ICT setups work beautifully and why others completely fail. Let's jump into it. What is a fair value gap? A fair value gap is an imbalance in price delivery. It occurs when price moves aggressively in one direction, leaving little to no two-sided trading between candles. This creates a three-candle structure where the wick of the first candle and the wick of the third candle do not overlap. It represents an area where price moved too quickly, and market participants did not transact efficiently, creating a temporary inefficiency in the auction process. Now let's talk about validation. From an order flow perspective, a fair value gap is essentially a low volume node. Markets naturally tend to revisit these areas to facilitate more balanced trade. But here's the key point. Some traders wonder why their fair value gaps don't get respected. Well, sometimes the zones they are looking at are not actually real auction imbalances. On a candlestick chart, it might look like an imbalance. But when you check the volume profile, you may not see a true low volume node. That means price didn't move through that area inefficiently, it simply moved. Let's look at this example. If we trace the volume profile from the start of the price swing, we can clearly see that the move down was inefficient and price moved aggressively with very little volume traded in between. As the market reached the bottom of the move, participation started to increase again, and we can see signs of balance forming. What we can do now is identify the low volume node created during the impulse, and instead of blindly selling or buying the imbalance, we wait for price to revisit that level and observe the reaction. What we see later is that the market attempts to auction higher again, but once price trades back into the low volume node, it quickly gets rejected. There is no acceptance in that area. That tells us the market still considers that level inefficient. Momentum then shifts, and the auction continues lower. Let's analyze another example. As we did before, we trace the volume profile from the beginning of the impulsive move. Notice how price is gradually building value as it auctions higher. Then, near the top of the move, a clear low volume node forms. If this low volume node gets respected on a pullback, there is a high probability that the upward auction will continue. Let's see how the market reacts. Price then pulls back into the low volume node. Notice how the market doesn't spend much time trading inside that area. There's no strong acceptance, no value building. Instead, we see rejection and continuation. This tells us the imbalance is still active. The LVN acts as a precise continuation level, not just a random zone, but a measurable inefficiency in the auction. And once it's respected, the upward move resumes. What is a liquidity sweep? A liquidity sweep occurs when price breaks a previous high or low, reaching an area where a large concentration of resting orders is located. As price trades beyond that level, a surge of execution occurs, increasing short-term volume and volatility. These levels tend to attract liquidity because they are obvious reference points in market structure. When price reaches them, orders get activated and the market temporarily accelerates. In order flow mechanics, a liquidity sweep is essentially a failed auction at a structural extreme. A failed auction means price tried to continue beyond a structural level, but lacked sustained participation in that direction. That lack of participation, especially when combined with absorption and delta divergence, is what differentiates a real liquidity reversal from just a breakout. When price reaches that level, what we look for next is order flow confirmation. Does the market absorb the move? Is delta shifting? Are buyers or sellers losing initiative? Is there rejection and a change in participation? A liquidity sweep is simply an inefficient test that fails to build acceptance. Structure gives us the location. Order flow tells us whether that sweep is real or just noise. Now let's look at this liquidity sweep example. Price breaks the previous structural low, inducing traders to expect continuation to the downside. However, the underlying order flow tells a different story. As price pushes below the low, we see aggressive selling hitting the bid. Sellers are accepting worse and worse prices in an attempt to extend the move. But despite this aggression, price is not progressing lower. This tells us that passive buyers are absorbing the initiative selling. On the next bar after the sweep, delta starts to increase, and continued selling pressure fails to generate further downside. This is a failed auction at a structural extreme. Once the market reclaims the level, the imbalance shifts, and price reverses for the rest of the session. Now let's analyze this second example. Price is approaching a zone of relative equal highs, a clear structural reference where liquidity is resting above the market. As price pushes through those highs, we see aggressive buyers lifting the offer, paying higher and higher prices to continue the breakout. From a chart perspective, it looks like continuation. But if we shift to order flow, something different is happening. Despite the aggressive buying, price struggles to efficiently auction higher. Large volume prints appear at the highs, but there is no continuation, which tells us passive sellers are absorbing that initiative buying. This is the key. Buyers are active, but they are no longer in control. On the following rotations, delta starts to weaken, and price fails to build value above the sweep level. That's the failed auction. The breakout fails, initiative buyers are trapped, and the market rotates lower from that structural extreme. What is an order block? An order block is typically the last opposing candle before a strong, impulsive move. It marks the area where a significant imbalance entered the market and caused price to reprice aggressively. Many traders expect price to revisit that zone because it can act as a reaction area, often functioning as support or resistance. From an order flow perspective, an order block is simply a strong support or resistance area where significant volume was previously exchanged and later defended. It's a prior area of agreement, a zone where significant business was done before imbalance occurred. Now let's focus on this example. The zone we're looking at is the perfect definition of an order block, the last opposing candle before a strong impulsive move higher. What happens next is interesting. Price comes back into the level and attempts multiple times to break below it, trying to continue the auction lower, but the level holds. Each attempt to push lower fails. The zone gets respected, and shortly after the market reverses for the rest of the session. Now let's break it down using order flow. As price comes back into the red zone, we immediately notice aggressive selling hitting the bid. Delta is clearly negative, which means initiative sellers are in control, but look closely. Despite the strong negative delta and repeated attempts to push lower, price is not able to break decisively below the zone. Sellers are active, but they are not getting continuation. Their effort is not producing result. This is another case of failed auction. After multiple failed attempts to auction lower, sellers become trapped, momentum shifts, delta starts to rotate, and the market rallies aggressively for the rest of the session. This is another great example of an order block validated with order flow. Price rallies aggressively, then comes back into this red zone, which is the last opposing candle before the impulsive move up. Now watch what happens inside the zone. Looking at the order flow, we can clearly see that before price reached the zone, sellers were in control. This impulsive move was supported by almost minus 4,000 delta, confirming strong initiative selling. But once price trades inside the order block, something starts to change. Selling pressure is still present. We see minus 941 and minus 620 delta, so aggressive sellers are still hitting the bid. However, price is no longer moving lower, and all that effort is not producing new lows. That's absorption. Passive buyers were waiting at this level. And once price trades into the zone, they begin absorbing all the incoming sell orders. Now initiative sellers are trapped, and as they start closing their positions, that fuel adds to the upside move. Sellers lose control, and the market reverses. If you made it this far, thank you for watching. Before applying these concepts to your own trading, make sure to properly backtest them, validate them, optimize them, and prove their profitability with data, not assumptions. This video was meant to be educational, to help you understand real market mechanics behind ICT concepts. If you found value in it, make sure to leave a like and subscribe to the channel. And if there's any concept you'd like to see validated with order flow, leave a comment below. I read them all. Also, follow me on Instagram and TikTok so you stay updated with practical trading insights and order flow validations that can help you become more precise and think differently about the market. See you in the next one.